hold onto your hats, because today's breakdown is a case study in sheer incompetence. When it comes to SiriusXM, ticker symbol SIRI, you'd think that even the most novice analysts could get the basics right. But no, what we've got here is a train wreck of epic proportions. These three so-called experts completely missed the boat, issuing calls that were so wildly off the mark, you have to wonder if they even read the financials at all. Were they asleep at the wheel, or was something more bizarre at play? And here's the kicker: what should have been a straightforward story about a company with a unique market position turned into a confusing mess of overestimations and blunders. By the time they finally came around to the real picture, investors had already been left holding the bag. It's a shame, really, because all the signs were there if you knew where to look. Which brings us to today's lesson: how to spot the red flags in financials before you end up riding a stock into oblivion. But don't worry, it's not all bad news. We've got not one, but two shoutouts today for the rare analysts who actually did their jobs and saw the writing on the wall before everyone else caught on. They weren't part of the circus, and we'll show you how their insights can help you avoid falling into the same traps. Now, as we dig into how some analysts got it so wrong, there's something you can get very right: mastering the power of AI. Just like how these analysts miss the obvious red flags, most people are missing out on AI's potential to revolutionize the way they approach YouTube. If you've ever thought about creating a successful channel but didn't know where to start, Matt Parr's Tube Mastery and Monetization course is your edge. With AI, you can automate growth and gain a massive advantage before everyone else catches on. Click the link in the description. As we uncover the web of financial blunders these analysts spun, it's hard to believe how many glaring issues they overlooked. Did they really think no one would notice? But before we dive into the Incompetence Court today, we'll start things off with a twist and take a moment to recognize two analysts who actually did their jobs. First, let's give a shout out to Jason Bazinet of Citi. He definitely demonstrated clear signs of competence with his insights on this one. Jason began his coverage of Siri in late 2018 and was essentially neutral as the stock was hovering in inflated and overpriced territory. He then segued into a buy call before the peak and then into a sell call right before the stock was about to tank. He did what a lot of analysts fear doing and warned investors of the rocky road ahead. Thank you for your competence, Jason. We salute you. Steven Cahall of Wells Fargo also displayed the same level of courage and competence. Steven began his coverage in early 2021 and was pretty much neutral. But in February of 2024, and before the stocks dip into the abyss, he also did what no other analyst dares to do and segued into a sell call, thereby warning investors of the financial pain that loomed ahead if they held on to this play. Great job, Steven. We salute you. Our other guests today, on the other hand, won't be getting the same warm welcome. They all handled this play with an egregious level of incompetence. Matthew Harrigan of Benchmark is being charged with gross incompetence. His inability to see the warning signs and make timely calls left investors blindsided, and we can't overlook the damage that kind of negligence inflicts on the market. This isn't just a minor slip. It's a complete failure to do the job, and the repercussions are steep. Order in the court. Our defendant is Matthew Harrigan of Benchmark. Matthew allegedly did absolutely nothing at work for the last decade. If you had done the opposite of what he told you, you may have made a little money. But on the other hand, if you listened to him, you would have dished out your savings to buy high and sell low, eventually earning yourself a cot in your nearest homeless shelter. Matthew began his coverage of Siri in 2014. He began by initiating a buy hold with a slightly overbid price target, which he quickly turned into a hold as the stock was at the bottom of its upcoming bull run, effectively telling people he doesn't know what's going on, as he should have been telling people to buy. As the bull run progressed, his overbids became more and more aggressive. Then out of nowhere, almost halfway through the bull run, he began touting the stock as a buy, but strangely and bipolarly switched from buy to hold again, and then back to buy, and then neutral buy, hold, buy, hold, buy. I think this guy clearly needs to be put on some sort of medication, or at least counseling to treat his bipolar disorder. He is all over the place, and the worst hasn't even come yet. As the peak, and also the crash, was approaching, Matthew decided to double down on his buy and grossly overbid the stock at 100, and essentially held on to this ridiculous position while chasing the stock down to make it look like he was doing work. He holds his buy to this day. As the stock hovers around $11, he is telling people it is worth $43, overbidding the stock by 290%. We find Matthew Harrigan guilty of gross incompetence and reject his defense plea of insanity. His erratic price targets resemble the kind of bipolar predictions we often see from analysts trying to justify their presence when it's clear they've been doing anything but their job. These wild swings in judgment don't stem from diligent research. They look more like the product of someone who's spent the last decade sipping martinis and snorting bad things rather than analyzing financial data. This courtroom has no place for such negligence. For sentencing, we hereby condemn Matthew to a lifetime sentence of manually reviewing penny stock charts at the least glamorous investment firm in town, with nothing but an abacus, a notebook, and a calculator from the 1980s. No more martinis, just endless numbers and spreadsheets as far as the eye can see. May this serve as a reminder to all analysts: negligence leads to a lifetime of financial purgatory. James Goss of Barrington is being charged with gross incompetence and copying Matt's homework. James began his coverage in November of 2014 and jumped right in with his pom-poms and began to play chase and cheer with his buy call. Then halfway through the bull run, he decided to segue into a market perform call, which he quickly segued out of and back into an outperform call that he soon decided to overbid tremendously. Long story short, James chased the price down, but overall holds on to this ridiculous overbid buy call position to this day, where his price target sits at $47.50, and the stock is trading at around $11, an approximate 331% overbid, at least at the time of this recording. Sound familiar? As you can see on the chart, James indeed copied Matt's homework, pulling the classic copy and subtract 2 tactic. He dialed back about 50% of the bipolar swings, but essentially, we're witnessing the same pattern of incompetence. Guilty as charged. For his sentencing, a lifetime of manually reviewing penny stock charts at the least glamorous investment firm in town. In solitary confinement, of course. We can't have him copying off Matt in there too. Our final defendant today, Barton Crockett of Rosenblatt, is being charged with profit assassination and acting as an unofficial relationship manager between his firm and SiriusXM. Barton began his coverage of SiriusXM in 2016, and for the most part, played chase and cheer with a couple of neutral segues thrown in the mix. Nothing out of the ordinary here, just the normal level of incompetence we would expect from Wall Street's finest. But after the peak and into the descent was when things got interesting. Barton saw the writing on the wall, but instead of issuing an outright sell call like today's stars, Jason and Steve, he simply gave a neutral rating and went silent, quietly chasing the stock price into the abyss. SiriusXM management probably loves this guy. He likely won an award at Rosenblatt for maintaining investment banking relations with SiriusXM. Oops, I mean for Analyst of the Year. Guilty as charged, and sentenced to personally pay back every investor who held onto this broken stock and lost money. Disclaimer: incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. Now that we've dished out the verdicts in today's Incompetence Court, it's time to step back and take a deeper look at how these financial disasters unfold. The question remains, how did these analysts, armed with years of experience and seemingly endless resources, manage to steer investors so far off course? To understand that, we need to dig into the backstory of SiriusXM and examine the red flags that were missed and explore the broader market conditions that allowed these missteps to happen. Buckle up, because this breakdown will give you the tools to spot the warning signs before you find yourself riding a stock into the ground. As we dive deeper into SiriusXM's tumultuous journey, it's crucial to understand the context behind the stock's dramatic decline. SiriusXM, a pioneer in satellite radio, once boasted a unique market position with a loyal subscriber base and innovative offerings. However, over the years, several critical factors contributed to the downfall of this once promising company. First and foremost, the competitive landscape began to shift dramatically. Streaming services like Spotify and Apple Music emerged as formidable adversaries, drawing away potential subscribers. SiriusXM, which had relied heavily on its exclusive content and programming, struggled to adapt its business model to compete with these tech giants. While other platforms offered unlimited access to music, podcasts, and other audio content, SiriusXM's rigid subscription model started to feel antiquated, leaving many consumers questioning the value of their subscriptions. On the financial side, we witnessed a series of alarming signs that should have raised red flags for any diligent analyst. Revenue growth began to plateau around 2020, when it dipped from about 35% to around 3%, and the company faced mounting pressure to retain subscribers amid increasing churn rates. Despite touting a strong subscriber count, the reality was that many of those subscribers were enjoying promotional offers or had not converted into paying customers. This discrepancy painted an inflated picture of financial health that analysts failed to scrutinize closely. Then came the mismanagement of expenses. SiriusXM invested heavily in acquiring exclusive content and producing original programming, but those costs did not translate into proportional revenue gains. Analysts should have recognized the unsustainable nature of this approach, particularly as the market shifted toward more cost-effective models. Instead, they overlooked the financial statement's warning signs, allowing the company to continue down a perilous path. Several critical fundamental warning signs should have raised alarms for analysts regarding SiriusXM's financial management. Rising operating expenses, particularly in content acquisition and original programming, outpaced revenue growth, leading to declining profit margins. Additionally, increasing debt levels and a decrease in operating cash flow suggested unsustainable financial practices. Analysts overlooked these signs, including diminishing returns on investment and escalating costs for subscriber retention, which indicated inefficiencies in managing resources. The disconnect between high subscriber counts and rising expenses further highlighted the precariousness of the company's financial position. Yet these red flags were largely ignored, allowing SiriusXM to pursue a misguided strategy. Moreover, the overall economic climate played a role. As interest rates rose and inflation impacted consumer spending, discretionary expenses like entertainment subscriptions became prime targets for cuts. In such an environment, the pressure on SiriusXM to retain subscribers while simultaneously dealing with increased operating costs became unbearable, leading to a steep decline in stock performance. Ultimately, it wasn't just one factor that led to the disastrous downturn. It was a perfect storm of competitive pressures, financial mismanagement, and economic headwinds that combined to sink the stock. Analysts who failed to grasp the severity of these issues and provide timely warnings left investors vulnerable to the fallout, turning a once thriving company into a cautionary tale of what can happen when the warning signs are ignored. As we analyze the fundies, it becomes clear the failure to recognize these red flags had dire consequences, proving that in the world of investing, vigilance and insight are paramount. Today's lesson is a crucial one for investors navigating the complex landscape of subscription-based businesses like SiriusXM. When evaluating subscriber numbers, it's essential to look beyond the surface. Many companies boast impressive subscriber counts, but a significant portion of these may come from promotional offers or free trials. These numbers can create an inflated sense of security that masks the true health of the business. Investors need to scrutinize the sustainability of subscriber growth and understand the conversion rates from promotional to paying customers. Moreover, as we've seen, revenue growth must be assessed in conjunction with rising operating costs. In a highly competitive and rapidly evolving industry, if operating expenses continue to climb while revenue growth slows or stagnates, it's a recipe for disaster. Companies need to balance their investments in content and services with the realities of their revenue streams. The first rule of investing should always be to avoid losing money. If a company's financials signal inefficiencies or unsustainable practices, it's a red flag. For investors, stocks like SiriusXM that show signs of financial distress, such as rising costs without proportional revenue growth, should be approached with extreme caution. It's vital to do your homework, assess the fundamentals, and remember that not all subscriber growth is created equal. In the end, prioritizing companies with sound financial health and sustainable business practices is the key to long-term success.